They're not raising prices, just shrinking the product. That way, you won't notice. This eye-opening quote from a food industry insider captures the sneaky reality of devaluation. Ever notice your grocery bag feels lighter while the receipt stays the same? That's your money quietly losing value. Now imagine money that can't play these tricks. Bitcoin's code-enforced scarcity stands in stark contrast. It can't be quietly diluted when no one's looking. While corporations shrink cereal boxes and chip bags, Bitcoin's rules remain fixed. Its price movements aren't just market noise. They're revealing an uncomfortable truth about our financial system's flexibility. Here's what they're really telling us. Ever notice your grocery bag feels lighter, even though you pay the same amount? That's devaluation in action. It's not that prices are going up, it's that you're getting less for the same money. The package looks the same, the price tag hasn't changed, but the contents inside have quietly shrunk. Take breakfast cereals and candy. Frosted Flakes dropped from 24 to 21.7 ounces, while Reese's Miniatures went from 40 to 35.6 ounces per bag, both about a 10% reduction. These aren't isolated cases. About 60% of household paper products have reduced sheet count since the pandemic. The rolls look identical, but you're getting fewer sheets. It's like an invisible tax. The price stays the same, while the value slowly disappears. Companies know customers notice price hikes more than shrinking sizes. As one insider put it, they're shrinking the product so you won't notice. The result? You're effectively paying more for less, but it doesn't show up in inflation numbers the same way. When your cereal box loses 10% of its contents, that's a 10% price increase per ounce. It just doesn't register when scanning shelves. Picture this. You grab party-sized Cheetos, same bright bag as always, but it's gone from 17.5 to 15 ounces, a 14% reduction. The per-ounce price jumped from 17 to 40 cents. These changes compound fast. Your grocery bill buys less food. Household supplies run out quicker. Your paycheck stretches thinner, even if your income hasn't changed. Matt Schultz, LendingTree's chief credit analyst, notes, finding 1/3 of products shrunk, in some categories even more, it's troubling. Most people don't track ounce reductions, they just feel the pinch at checkout. This hidden erosion makes budgeting harder. With visible price hikes, you can adjust. With silent shrinkage, the damage is done before you notice. Devaluation hits hardest when margins are tight. A 10% reduction here, 15% there, forces trade-offs, generic brands instead of favorites, or skipping treats altogether. Your standard of living declines incrementally, invisibly. This erodes long-term savings too. $1 saved today might only buy 80 cents worth of groceries in 5 years. Understanding devaluation means recognizing how your purchasing power is being quietly chipped away, not just through rising prices, but through shrinking packages. It's inflation's sneaky cousin, eating your money while you're not looking. Inflation means your money loses its punch, not just because prices rise, but because each dollar buys less as more enter circulation. Picture a glass of orange juice. Keep adding water, and the flavor weakens. That's what happens when central banks print money. The official inflation rate might say 3.0%, but your wallet tells the real story. The money supply has exploded, and to cash, checking accounts, and near money grew from $4.6 trillion in 2000 to $20.8 trillion today. This 350% increase dilutes purchasing power. Imagine saving for a dream home, only to watch your $100,000 stash shrink to $60,000 in real value over 2 decades. The dollar lost 40% of its buying power since 2000. This isn't accidental. It's how the system operates. Debt growth forces central banks to create more money, eroding existing currency's value. Since 1971, when the US left the gold standard, the dollar lost 85% of its purchasing power. Even at low 3% inflation, money halves in value every 24 years. Wages rarely keep up. Housing, healthcare, and education costs outpace official inflation rates, leaving paychecks stretched thinner. Traditional hedges falter. Gold dropped from $850 to $250 between 1980 and 2000, taking 28 years to recover. Real estate crashes when rates rise, like in 2008. Even tips, pegged to CPI, fail because CPI understates real inflation. If your hedge tracks flawed metrics, you're still losing. Inflation is structural. Governments need it to shrink debt's real value. A 5% inflation rate makes $100,000 debt easier to repay over time. But your savings decay too. It's a silent tax, punishing savers while rewarding borrowers. After 2020, the Fed's balance sheet doubled to $9 trillion. Asset prices soared, but wages lagged. Bitcoin surged from $7,000 to $69,000, reacting faster than gold to inflation shocks. Its fixed supply, 21 million coins, contrasts with unpredictable dollar printing. Global liquidity grows 8% yearly. The Nasdaq's 97.5% correlation with liquidity shows how money floods into scarce assets. Bitcoin's 85% correlation reflects its role as a hedge, but with clarity. Everyone knows its supply. No one knows how many dollars will exist in 5 years. Inflation is the tax no one voted for, but one asset breaks the cycle. What if money had rules even governments couldn't bend? Bitcoin makes this real with its fixed supply of 21 million coins, hard-coded into its protocol, immune to central bank decisions. This digital scarcity mirrors gold's finite nature, but with transparency no metal can match. Central banks manipulate supply at will. In 2020, the Fed ballooned its balance sheet from $4 trillion to $7.4 trillion overnight. Bitcoin's issuance, by contrast, follows a rhythm as predictable as seasons. New coins enter circulation every 10 minutes, and every 4 years, mining rewards halve. The next halving will soon slash Bitcoin's inflation rate below 1%, tighter than gold's. This scarcity mechanism creates Bitcoin's stock-to-flow ratio, measuring existing supply against new inflows. Each halving pushes Bitcoin closer to gold's profile, but with a twist. While gold's supply shifts with mining discoveries, Bitcoin's trajectory is auditable by anyone. By 2021, as central banks printed trillions, Bitcoin surged from $7,000 to $69,000, reflecting an 85% correlation with global liquidity. It wasn't speculation. It was Bitcoin acting as a monetary canary in the coal mine. Transparency anchors Bitcoin's value. Unlike fiat systems, where money supply changes hide behind closed doors, Bitcoin's rules are public. 19.5 million coins exist today, and the next halving's date is known. Mining reinforces this trust. As Satoshi Nakamoto noted, the price dictates the cost of production. More value attracts more miners, strengthening the network. A self-reinforcing cycle alien to fiat, where printing erodes value. Crises reveal Bitcoin's independence. While stocks wobble on policy shifts, Bitcoin often holds steady, untethered to any nation's monetary whims. Its 4-year cycles align with halvings and debt refinancing waves, reacting to currency devaluation in months, not years like gold. This explains why MicroStrategy and spot Bitcoin ETFs now treat it as treasury armor. They're not gambling. They're hedging against the very monetary expansion Bitcoin exposes. Its volatility isn't noise, it's a signal. When Bitcoin spikes amid money printing sprees, it's flashing a warning. Your dollars are losing ground. Here's what happens when these systems collide. Bitcoin's wild price swings aren't random. They're flashing urgent signals about monetary policy that every investor should understand. This volatility serves as a real-time inflation barometer, reacting instantly to changes in money supply. When the Fed printed trillions in 2021, Bitcoin surged from $29,000 to $69,000. When rates rose in 2022, it corrected sharply. These weren't coincidences, but economic reflexes. Institutional investors now treat Bitcoin as a monetary dashboard. The state of Wisconsin's $160 million Bitcoin ETF allocation and MicroStrategy's 214,000 BTC Treasury holdings represent strategic hedges against currency devaluation. Spot Bitcoin ETFs attracted $3 billion in early 2025 alone because they offer direct exposure to these monetary signals. The 4-year cycle theory reveals Bitcoin's rhythm. Halvings, elections, and debt cycles converge, with each halving cutting new supply just as monetary policy typically loosens. The next halving will push Bitcoin's inflation rate below 1%, outperforming gold. Research confirms Bitcoin rises with inflation expectations, but ignores policy uncertainty since no government controls its 21 million coin supply. Traditional hedges move too slowly. Gold took years to reflect 2008's money printing, while Bitcoin responds within weeks. Tips tie to flawed CPI metrics. Bitcoin's advantage: it incorporates all monetary policy information instantly through its price, like a pressure valve for global liquidity. The 85% correlation between Bitcoin and money supply proves this relationship. Charts make it undeniable. Bitcoin's 2020 surge from $7,000 to $69,000 matched the Fed's money printing, while 2022's drop aligned with rate hikes. Unlike stocks or bonds tied to earnings or interest rates, Bitcoin reacts purely to monetary conditions, often moving before traditional markets price in changes. Sharp rallies frequently precede unrecorded inflation. This makes Bitcoin unique, a transparent, rules-based system that exposes monetary stress in real time. While central banks operate opaquely, Bitcoin's code is auditable, its halving schedule public. Its price movements reveal currency debasement as it happens, not years later when official data catches up. The implication? Bitcoin's volatility isn't noise, it's translating monetary policy into price action. When your dollars buy less, Bitcoin often rises not because it changed, but because the dollar did. Traditional hedges remain tethered to the old system. Bitcoin operates outside it, providing earlier warnings. This leads to a critical question. If Bitcoin signals monetary stress first, how should you respond? The next section details actionable strategies, but the insight is clear. Ignoring these signals means missing early warnings about purchasing power erosion. Bitcoin doesn't just store value, it measures it against a fixed standard, exposing inflation in real time. Gold and real estate have been the go-to inflation hedges for generations, but they're showing their age. Gold returned about 20% from 2012 to 2023. Bitcoin returned 20,000% in the same period, a difference that redefines wealth preservation. Physical assets come with baggage. Gold requires costly storage and insurance, while real estate ties up capital with high transaction costs. Both move sluggishly when markets shift. The 1970s stagflation exposed these flaws. Gold prices tripled, but real estate values stagnated. Homeowners saw property values barely keep pace with inflation, while maintenance costs soared. Julian Bridgeton's macro winter concept explains why traditional hedges fail during stagflation. Even inflation-indexed bonds like TIPS struggle, as CPI doesn't capture real-world price shocks accurately. Storage costs silently erode gold's returns. Safe deposit boxes, $100 a year. Home insurance, thousands annually. Bitcoin custody costs nothing beyond a $50 hardware wallet. Liquidity gaps compound the problem. Selling a house takes months. Gold ETFs still rely on middlemen. Bitcoin trades globally 24/7, settling in minutes. Georgetown economist James Angel notes that anything everybody already knows should already be priced in. Gold's inflation hedging role is priced in, capping upside. Bitcoin's price discovery evolves with adoption. Yes, 5 mining pools control 67% of hash power, but gold faces concentration too. 4 refiners process most global supply. The key difference? Verification. Bitcoin's blockchain is transparent. Property records languish in fragmented local registries. Transaction costs tell the same story. Gold dealers charge 1 to 5% premiums. Real estate commissions hit 5 to 6%. Bitcoin fees typically stay under 1%. Volatility comparisons miss context. Gold lost 70% in real terms from 1980 to 2000. Its stability came at a cost. Bitcoin swings reflect rapid price discovery. As economist Sylvia Del Bianco observes, both assets are driven by animal spirits, but Bitcoin reacts faster. COVID revealed the divergence. Both crashed initially, but Bitcoin's rebound dwarfed gold's as money printing accelerated. Research shows Bitcoin responds to inflation shocks more sensitively, making it a leading indicator, not a laggard. Production contrasts are stark. Gold mining grows supply 1.5% yearly, indifferent to price. Bitcoin's issuance is hard-coded. Mining difficulty adjusts, but the schedule never bends. Try telling a gold miner to halve output because prices fell. Real estate carries systemic risks gold avoids. In 2008, property collapsed globally. Gold rose, but landlords still faced mortgages. Bitcoin didn't exist then, but its 2020 COVID response showed resilience, crashing with markets, then soaring as liquidity flooded in. The digital edge changes everything. Gold can't cross borders instantly. Real estate can't split into micropayments. Firms like MicroStrategy leverage Bitcoin's programmability for corporate reserves, impossible with bullion. Land can't be rebalanced with a click. Traditional hedges worked in slower economies. Modern finance moves at digital speed. Gold's ancient role grants staying power, but limits upside. Real estate offers utility but ties to local markets. Bitcoin operates globally, unconstrained. The rules changed. Your strategy should too. Your savings are under attack right now, and doing nothing means losing. While you can't stop inflation, you can absolutely protect yourself by diversifying beyond traditional stocks and bonds. Start with a small Bitcoin allocation, just 1 to 5% of your portfolio, to hedge against currency devaluation. Studies show Bitcoin's correlation with inflation exceeds 85% during monetary expansions. Timing matters. The macro seasons framework divides economic cycles into 4 phases. When the ISM Manufacturing Index rises above 50 macro spring, stocks thrive. Summer brings slower growth. Fall signals contraction. Favor cash or bonds. And winter means recession, when gold shines. Bitcoin proves resilient across most seasons except extreme liquidity crunches. Here's how to start. Dollar cost average. Invest $100 weekly into Bitcoin. You'll buy more when the prices drop, less when they rise. This smooths out volatility. Over time, the upward trend outweighs short-term swings. Take cues from institutions. MicroStrategy holds Bitcoin as digital gold in its treasury. Wisconsin's pension fund allocated 1% to Bitcoin ETFs, calculated hedges, not gambles. One investor I know started with 1% in 2019. That allocation now covers his family's annual groceries, despite inflation. Compare assets wisely. Gold needs secure storage. Real estate lacks liquidity. Bitcoin trades globally 24/7, settles fast, and fits digital age risks. Understand Bitcoin's edge. Only 21 million will ever exist. Every 4 years, new supply halves. The halving. This scarcity drives value when central banks print money. Action steps. 1. Start small. Even 1% in Bitcoin matters over time. 2. Use reputable exchanges or ETFs for easy access. 3. Store most in a hardware wallet. Keep some liquid. 4. Track adoption, business usage, institutional inflows. Remember, a 5% return loses to 7% inflation. Bitcoin's volatility seems scary, but focus on purchasing power. The Lightning Network now handles 6 million plus monthly transactions, real utility beyond speculation. Waiting for the perfect time guarantees missed opportunities. Inflation won't pause for you. Small, consistent steps compound. Whether buying Bitcoin weekly or learning monetary policy. Traditional strategies worked in a different era. Today's economy demands new tools. Bitcoin belongs in your financial toolkit. Starting now protects what you've worked so hard to save. Bitcoin exposes a fundamental flaw in our money system through its fixed supply, something no central bank can replicate. The steady devaluation of currencies isn't accidental. It's baked into fiat money. While dollars and euros lose value over time, Bitcoin's scarcity holds up a mirror to this erosion. This week, notice one example of devaluation in your life: shrinking product sizes or rising prices. Ask yourself, what else might I be missing about how money works? The pattern becomes clearer the more you look. Next time you check your wallet, remember, Bitcoin is quietly revealing the cracks in our monetary system. What will you do differently?